I am so thrilled to introduce the panelists today. Do we see Will Stringer? I'm just trying to see.
I'm here.
Hi, perfect. Okay. So Will Stringer is here, Shant, Sood, Bill Timmerman, and Alan Snyder. And gentlemen, I will ask you to just maybe give us a little taste of your experience and background, not too much, but just by way of introduction, because we will delve into your strategy and what you're doing and how you're different. So I don't want to get into, what you offer to the world. I just want to come the introduction. I know you're laughing at me, but I just want like a brief intro. And after that, we will delve into the current macroeconomic environment. We will delve into what you're doing. And of course, we will delve into what you recommend to everyone who is listening to us. So with that being said, Alan, why don't you go first?
Oh my God.
Okay. On the big screen. Go ahead.
Marty describes my background as misbegotten youth, checkered past, can't hold a job, and I think he's correct. Rather than bore anybody with my past, if anybody's curious, go to Shinnecock, that's SHINNECOCK.com. As you can tell by my youthful appearance, I've done endless things, and I basically start financial services companies.
Fabulous. Welcome to the panel. It's so great to have you. All right next to you, at least I'm looking at my Zoom. Will, would you like to introduce yourself next, please?
Sure, thanks. So my name is Will Stringer, co-founder, CEO of Chisos Capital. My background quickly started in banking in the oil and gas sector. I actually worked at a family office, oil and gas family out of Houston. So I started coming to Marty's events as a family office rep on the other side. Transitioned into the startup, more venture world. And with Chisos, which we started a few years ago, we're investing directly in people with asymmetric upside potential. So think entrepreneurs or athletes. And we're providing capital to them to jumpstart or grow their career.
Wonderful. Thank you so much. Shant, you're here, please.
Hi, Julia. Thanks for having me. Thanks also, Marty, for inviting me to this wonderful panel. I'm Shant Sood. I'm a managing partner and co-founder at Sanctum Investment Management. Sanctum is an alternative investment firm that makes primarily debt investments into mid to late stage technology companies. Unlike venture lending, unlike venture equity, our segment, venture lending, is vastly underserved, and we believe there remains significant opportunity for high risk-adjusted returns, especially in today's markets. My co-founder and I have been successfully investing in technology companies over the past 20 years and through market cycles. I really look forward to our discussion today.
Thank you so much, Shant. Welcome. And last but not least, Bill Timmerman is out there. Bill, you are muted.
Sorry about that, Julia. Thank you very much for inviting me. And Marty, thank you very much for inviting me. I appreciate that. I'm an investment banker with Xnergy. We work on the lower middle market. We help companies raise capital, and we advise them on the sale of their business. I've also run companies. I've been on the other side of the street. I've run companies, and I've also been a CFO for venture capital, for private equity based businesses. So go ahead.
Bill, welcome and thank you. So we have such a tremendous panel, and the breadth of it, only Marty can put a panel together like this. Okay, so this is going to be such an interesting discussion. And in our master plan here, we're going to get into the rising interest rates and macroeconomic environment, and basically, where is lending going, right, at this point in the market cycle. So why don't we, would you like to go into say, actually, let Shant, I'm gonna come to you because kick us off on that, on macro. Mhm.
Sure. In terms of the macro events, what pretty much every asset class is facing today is a confluence of just sort of cataclysmic impacts, right? So you've got the rising interest rates that are super high at the moment. You've got public market volatility, and in my world, certainly tech has been even more volatile than that. You've got an impending recession. You've got macro issues around the world. This is the kind of event that I think most of us on the panel and in the audience probably anticipated something like this, because we literally came off of what I call a sugar high of investments during the pandemic, when so much capital was pumped into, again, in my segment, into venture capital, that you kind of anticipated that something like this would happen. But in this economic environment, as in the case with the great financial crisis, as with the dot-com crash, you have the seeds of what could be amazing investment returns. And so it's a terrific time to be a fund manager, to put money to work. It's a terrific time to be an entrepreneur who's starting a company. This is where you get things like the next Google, the next Facebook, et cetera, that come out of the ashes, so to speak. I think with respect to lending, in a world where, and this certainly echoes the previous panel, where allocators are having such a tough issue, and a number of big pools of capital are over allocated. I think lending is a very interesting place to be, because you have the rising interest rates, you have an ability to cut through a lot of the equity volatility that you see, and we'll certainly get into that with our strategy and why it's powerful today. But I see various pockets of lending, and certainly the alternative lending strategies that are on the panel today, as being a real differentiator versus the vast other segments of both equity and debt. I'll just take a quick pause there, but that's sort of just to kick us off.
Thank you, Shant. Well, let's continue with this thought, especially on the people side, right? Was on the entrepreneurship side. Can you talk a little bit what you see?
Sure. Yeah. I think, where I play is at the very earliest stages, and it's part business, part consumer, depending on what segment we're in. And so if we think about the business side of things, where we started, which was providing capital to early stage entrepreneurs, there really is no true lending product at that stage. You're a pre-seed or seed stage startup. You're not going to get any kind of debt, especially if you don't have any kind of revenue. So there's no real product there. I think, a competing product for us is a consumer credit card or a consumer loan. And we've just seen the continual ramp up of lending standards from banks. And so many people that want to go to a bank to take out a loan to start a business, that's just not an option. So in terms of actual credit at that earliest stages for people that are trying to bootstrap or kind of jumpstart their career, it's not available. And then the last thing I'd say there is, over the past, call it 6-ish months, for us, we used to be investing in day one founders. So you're just getting started, you don't really have other great capital options. Well, now we're seeing more and more founders of companies come to us that are at a kind of seed stage level, and they're looking for bridge capital. So that's a function of some of the earlier stage VC capital pulling back a little bit. And because we offer an alternative capital product, these founders need the money to continue building their company. And so they're turning to us. And so we're seeing, even better deals as other sources of capital pull back.
Okay, this is fascinating. And Bill, you are on the other end of that cycle, because as Will is helping entrepreneurs start their company, you're actually helping people exit. Right?
Also helping them raise. I think you have a point, but I think I'm also at the stage where what Will is doing is useful to know, simply because bridge loans are needed. You do see that people get running out of capital. Some of our clients, fortunately, the good ones are the ones we want to deal with, still have a good runway of at least 6 months or 12 months, and the really good ones are actually EBITDA positive, which is pretty rare. But otherwise, Will's product is pretty good. And Shant, he and I had a discussion yesterday. My guy's a little early stage, people I'm working on now, but Shant will be back.
All right, and Ellen, you work in the fractionalization area and tokenization or fractionalization of private equity, real estate is so top of mind these days, and you have a super interesting fractionalization offering with fine art. Can you please talk about that?
Sure. What we're doing, we do lending against museum quality fine art. That's on one side, it's specialty finance. On the other side, we've started a new company called AssureX, Art Share Exchange. And basically what we're doing there, we're democratizing the art world by giving people the ability to buy a fractional share in, for example, let's say a $10 million Picasso that today they can't afford. We will do that through a securities offering, and we will do it very unusually with an auction, so they get market-based pricing. We create a secondary market for those shares. And third, and here's a shocker, duty of care for investors. The investors, not some intermediary, controls the stock and makes the decision if they want to sell the underlying art, in case there's a discount between the secondary market and the net asset value of the piece of art. So that's what we're doing. We're filed a patent on the auction system, since those auctions don't exist, where you can have fractional bidders compete head to head with 100% bidder.
Wow, that's fabulous. So let's delve a little bit more into your strategies. Shant, in terms of venture debt strategies, can you talk a little bit about the asset class in general? I mean, it's less well known, and just for the sake of our audience, maybe just a brief primer would be very, very helpful, and kind of talk about your strategy, how you were doing it as well.
Sure. So everybody understands venture capital and the venture equity landscape. We also understand private credit and the various forms of debt that's available to generally profitable companies. So venture lending is actually the intersection between technology and lending. And it's actually a segment that's been around for a good 25 years, but just hasn't received the same level of attention nor the volume of capital as venture equity. So Sanctum is an alternative investment firm. We primarily make senior secured term loans to mid to late stage technology companies. In addition to the term loans, we also pick up warrants and equity kickers. Once you put all of that together, our returns are closer to 20% on a gross unlevered basis. So the debt itself is somewhere in the 11 to 15% range. A lot of that is current cash pay, and the rest of it is made up in the form of accruals and warrants and equity kickers. If you look at the borrower profile, it's essentially a technology company that has achieved at least $10 to $15 million of core recurring revenue. And we strongly advise companies that have less than that volume of revenues to really think through whether debt is even the right option. Because once you take on debt at that level, you actually have a base of operations, recurring revenue, institutional equity, mostly from the VCs, where you're able to take that venture debt and really add fuel to your business. As an asset class, venture lending delivers this very consistent yield throughout market cycles. So my partner and I have been at this. We started during the dot-com days. We went through the GFC. We've been at some of the best funds that do this. Some of the best funds are publicly traded, so there's plenty of data. But the yield profile has been very, very sort of steady throughout all of these times. The loss rates have been dramatically low, less than 1%. So it doesn't really make a lot of sense if you're lending to negative EBITDA technology companies. But the fact is, once you lend money to them after they've achieved that inflection point, which is roughly $15-ish million of revenue, you end up with a very strong, very uncorrelated borrower, a borrower that has substantial enterprise value built up from its venture equity investment from the venture capital community, but in addition has a software product or any other technology product that is mission critical and very hard to replace. So we focus on this segment. We've enjoyed very low loss rates, very consistent yields, just like the rest of the segment, and we would be happy to delve into more detail on that.
That's fabulous. Bill, I would like to give you a little bit more time to kind of talk about not all, because you don't have a strategy, you have a service, but the way that you deliver that service is very unique because your personality matters, right? So if, as anyone who's been in a family office, worked for a family office, or dealt with a partnership knows there's a lot of, personalities matter and people skills matter as well. So can you bring out kind of what's unique in?
I don't know. We are unique. I know that our clients are unique. I think every client we have is an entrepreneur, and we never have done a deal that is a nice, easy deal. Every deal I've ever touched or been involved with has always failed at least 3 times. I mean, we had a guy with a great healthcare business. We have this great offer from a strategic backed by a private equity company. We get, they give us a price up here, nice clean terms. Then we realize they're baiting and switching us because suddenly they come back with, oh, we can't do those terms, we've changed it. So now we say, are we just going to sit down and accept what these mothers are telling us? So we go out and we go find all 3 or 4 alternatives. We tell them, well, your terms are now not your price is not going to be the same. So we negotiate a higher price, higher this and that. So our client, at the end of the day, like the strategic guy, didn't like the owners. They did the deal, but they got better terms. So we actually were kind of useful. So the other one we have found that's really strange is the very fact you hire, or that people have hired us, has brought some investors out of the woodwork. We had a guy in the fast food business. He wanted to raise capital and more debt. And he had a bank, and this bank wasn't going to lend to him, he thought. So he said, forget them. They're not going to touch us. So, of course, that didn't take us long to realize that this was a non-starter. Something's wrong here. We called the bank and say, hey, we got this deal. They realize they've got an investment banker involved. We're going to lose $10 million in deposits. The bank made a very good deal, cut the price of their loan about in half and increased the amount, and off they went. Happens all the time. So our stuff is hand holding and getting it closed, which is not a trivial matter after all. We actually do offer a service when you get down to it. Not easy.
Okay.
You don't see that in the beginning, they see in the end.
That's fabulous. Will, when you are dealing with entrepreneurs, how much of your process is done through tech and how much of the person-to-person element is there?
Yeah, I'd say 2/3 of the person and 1/3 on tech or the company if it's an entrepreneur. So as we're doing our underwriting, that's kind of the breakdown of what we're looking at. But at the end of the day, we are investing in a person. Started with entrepreneurs, we're starting to dabble in athletes. And I'll just give you a few examples because it is a bit unique. And since Shant did a good job of talking about venture debt, think about that, but scaled down to a person. Yeah. A person has a future earning potential. They are going to make money, W-2, 1099 consulting, like they're going to make money. So they have a cash flow stream. And so what we've done is say, okay, this person has a cash flow stream. And specifically, the people that we're investing in are looking to do something with an asymmetric upside. Shoot for playing in the major league sports arena, shoot for building a $1 billion company, shoot for getting, 50 million Twitch stream subscribers, something big, but they need capital today to grow their business or grow their career. And so we're using their future earning potential essentially as collateral to pull that forward, write them a check today, and then collect on their income stream as they earn it, and only when they earn it over a certain threshold. So it's a very kind of person business. because we are investing in that person. And we're very upfront and say, look, our terms are a bit different. And here's the worst case scenario. We invest in you today. Tomorrow, if you're an entrepreneur, your company goes bankrupt, we're still invested in you. And so we're still going to try and figure out, how can we help you get a job? How can we help you start your next company? Because we're on the same side here. We're now incentivized to see you succeed and see you make a lot of money, because that's how you'll end up paying us back. So yeah, to answer your question, it's a very personal business. And as we're investing in people, that's a big element of it.
Wow, that's fabulous. So from here, let's go to art. Alan.
Well, just to put it in perspective, as I listen to my fellow panelists and I think about how I think people are underestimating inflation, given the wage stickiness, the costs of onshoring, which were alluded to, China possibly reopening. I think of my fellow panelists all in their own way doing niche types of investments, which are, I think, more anti-fragile. And therefore, on lending against museum quality fine art, here's the reason that it warms my black heart. I'm the largest individual investor in what we're doing. We lend to gallerists and dealers. Why? They have huge financing needs, and it's one level, it's very prosaic, it's inventory finance. Now, we're basically doing one-year term loans. And then, here's the part that's pretty nifty. We take delivery of the collateral. We file a UCC1 against the collateral. We hold it in a protected art storage facility. And the thing that's powerful about art is it's a hard asset. That's great. We're lending against Picasso, Basquiat's, whatever. And it's an international asset. It's like gold. It moves around the world like gold as currencies fluctuate. So if the US market is down, you can sell it in Hong Kong, you can sell it in London, you can sell it in Abu Dhabi. So it has some very attractive, like my fellow panelists, indicia associated with what it's doing. Now, the one hedge I'm going to say, having run a $20 billion debt portfolio in my youth, I look at the explosion of generic private credit. And I think back to restructuring too many high yield bonds. I think you want to invest in niche strategies today, like my fellow panelists. Credit, the generic private credit is high risk. Everybody talks about recession. Well, if you have a recession, there will be significant problems in those portfolios.
Mm-hmm.
And an ounce of prevention is worth a pound of cure. So I would say stick, as long as you're in private credit or specialty lending, stick to nichier, like Shant, like Williams, Bills, all of that kind of stuff. Art I like because it's a hard asset. And over the last 50 years, it's appreciated at a compound 8%. That's nice. It gives you an extra cushion to protect against the unexpected.
Actually, you're hitting on returns, and I'd love to stick with that theme because that's so important, right? The obviously the fact that it's uncorrelated and it's so specialized. So why don't we continue with that? Shant, can you talk a little bit, please, about your returns, the competition, what differentiates you, specifically in how you approach things, and then I'll ask Will and Bill kind of to talk along the same lines.
Sure. In terms of returns, again, our returns are composed of a couple of different sources. So the first is the credit source itself. So our senior secured term loans essentially earn an 8 to 10% current cash return. So we collect the cash on a monthly basis, plus another 2 to 4% on top of that with respect to accrued PIK. So all in, just the credit piece itself is somewhere in the 11 to 15%. And then on top of that, we do pick up very interesting warrants and equity kickers in our portfolio companies. So if you imagine a Series B or a Series C company that has received debt from us, we would pick up warrants generally priced at the last round of valuation. So we're automatically in the money on the warrants in anticipation of their next round. But then we also pick up equity investment rights in the next round. So you pick up these warrant and equity kickers, and they add roughly another 5-ish% onto the overall return. So that's how we get to our target returns that we're shooting for in the fund. And this echoes the returns across the asset class. So if you look at some of the other competitors, they will report numbers on a net basis, but they're generally all in the same place. I think in terms of differentiation, what's interesting about us is that venture lending is massively underserved. So we don't need to necessarily steal a share of pie from someone else. The pie itself has much more room to grow. So in the last couple of years, we've seen 100 billion go into venture equity. Venture debt is a drop in the bucket compared to that, somewhere in the $2 to $10 billion range. And I'm adding in commercial banks and all that into it. So even if you had, if you double the number of competitors we have, and there's only a handful of them, you'd still be underserved. I like the following fact. There's about 1,500 venture equity firms in the US managing about 3,000 vehicles. There are about 8 to 10 venture debt funds, including ours. So it's a scarcity of underwriting and origination capability because we're at the intersection of tech and credit. And therefore, in terms of differentiation, there's going to be thousands of companies that are looking for capital to grow now and into the future. And there's just not going to be enough venture lenders to service that kind of demand. So we are certainly very happy with the supply-demand imbalance. We routinely look at fantastic companies where nobody else shows up because there's just not enough of us to go out.
Yeah, and I literally hear stories in fintech where thriving companies were shutting down just because they couldn't raise another round.
Right.
So yeah. Will, would you talk a little bit
Sure, yeah.
more depth about who are you hit on your competitors already, that it's the credit card and the PayPals, right, and Marcus and and stuff that you get in the mail, but can you talk a little bit more about kind of the returns and overall your observations on the market you play in?
Sure. Our return profile is remarkably similar, again, to Shant and the venture debt. So with our income share agreement instrument, which is our quasi credit instrument that basically says, individual, when you earn money over a specific threshold, $40,000 or $50,000 a year, you pay us 10% of your income. That instrument alone is targeting about a 12 to 15% return. There is cash pay associated with that, and that cash pay typically ramps up. So when we make an investment, a lot of times people don't have an income because they're working on their business. Usually, and we've seen this play out over the past couple of years, within 12 to 24 months, they either raise their next round of capital or kind of hit their goals, start paying themselves a salary, or more often than not, their company shuts down and they go back and they get a job. When we're underwriting these individuals, these are six-figure earners already. They've already proven that they can earn, in the six-figure range. So pretty low risk in terms of their ability to find income, get a job, and pay us back. So that ISA, 12 to 15%. And then we have the equity upside as well. A lot of times that is structured as equity in their early stage company. And we think that adds anywhere between 5 and 10% of additional return to where we're targeting 20 to 25% returns. Now, if you take an athlete, sub out equity for in-sport income. So the athlete, we make the investment, they go train full-time at the best pitching camp, in Florida or North Carolina. And if they end up making, say, the 40-man roster on a major league team, their minimum salary as a member of that team is going to be $750,000. That's the minimum in the MLB. And so their in-sport income is the equivalent of the equity for an entrepreneur. And they pay us, a chunk of that in-sport income as the upside. And so that's how we're structured. And yeah, it's about 20 to 25% returns. I'd say our differentiation is our availability. So if you have ever tried to go get any kind of bank loan, let's say you were a 1099 or a consultant, a bank would rather lend to an individual who's got a steady W-2 that's at half of what a consultant would make on a 1099. So there's just not great credit options for the person that's not in that W-2 box. And especially if you're trying to do something that's mildly risky, like train for an Olympic sport or start a business, God forbid. And so that's where we're stepping in with an available product, because we've structured it in a way where we can get sufficient upside by taking the risk of the non-mandatory monthly payments that are traditionally a feature of a traditional credit product. So that's our differentiating factor.
Wonderful, thank you. Bill, coming to you, we wanted to talk about your differentiating factor. And it's the fact that you can help people break through whatever is holding them back from actually doing the deal. But is there anything that you can tell us about the sectors that you work with, where you see most of the deal flow these days? And, just give us some color around what you're doing.
We see deal flow, and we're not specialists, we are generalists. So we see deals right now. It seems in the last 6 or 8 months, we've seen a lot of healthcare deals, healthcare technology, medical devices, healthcare IT. We've seen the classic software deals also. We occasionally see a manufacturing deal, although we see far less of that. We occasionally see high technology. We've had wind service companies. We've had, as I mentioned, other healthcare. We have had, we even financed some money once years ago for a coal mine. So we've helped a UK company raise capital coming into the US. We have anything that people need money for. If we can understand it, we can do it. And I don't think our clients understand the differentiation initially. It's only once they get involved in the weeds that they start to understand this is not a trivial matter to raise capital.
Yeah.
So those, I think, once the ones we really like are who've tried it themselves and failed, then they start to listen. And when they listen, we can actually work better. So I don't work with my wife.
All right. It's, what, I can second that, because in technology, a lot of times it's a similar process. People go through building out their tech, and then they come to us, and it's much, much easier to work with them, Okay, so we have about 13 minutes on the panel, and I want to leave maybe 5 minutes for questions. So I will open it up to you for kind of closing statements, and anything that I forgot to ask or you forgot to mention in your answers. Anything that you'd like to highlight specifically?
Julia, just a quick reminder, you have about 15 minutes to go.
Yeah. Oh, believe me, our closing statements will take some time. Go ahead. Alan, we can come back to you if you'd like.
Sure.
Mm-hmm.
It's interesting to me. You look at the average pension plan or endowment, even better. They are hard pressed to get a compound 6% return through thick and thin. Therefore, how do you achieve that? Everybody, I heard somebody say earlier in the panel, gee, I'm looking for a 12% north returns. Well, if everybody really achieved that consistently without loss, the endowments would be earning considerably more than 6 or 7%.
Right.
So on the one hand, the very conservative stuff that we do is lending against fine art. We possess the collateral. If you don't pay us, we're going to sell the collateral. Our LTVs are about 40% against the value of the artwork. So very conservative. What's the yield? In a pooled vehicle, it's 7% plus net to the investor. In the sidecars, of which we do endless, it's probably around 9 to 10, maybe 10.5, sometimes with a profit participation on the one hand. On the other hand, is this new company that we're doing, which will change the art world, where we integrate the whole SEC ecosystem into it, so that it solves some of the earlier panels were talking about that problem. The SEC is stirring themselves. So we have that in hand, plus the market-based pricing, pretty nifty way to participate in high-end art, whether it's a pension plan, a foundation, or even an endowment, or an individual. Here's a shocking statistic. 90% of all auctions are for art that is less than $50,000 in value. Now, putting all this stuff together is a challenge. However, think about it. Everything we're doing applies to any hard asset. In my youth, I built a big real estate syndicator. We were doing $1 billion of principal a year. It clearly applies to real estate, any collectible asset. So pretty exciting to me.
That is wonderful. So,
Hey, Julie, can I just jump in here 1 second?
Yeah.
I've got a question for Alan, and actually for all the speakers. How do you guys deal with a markdown on the asset value? I mean, a lot of you guys are asset lenders in some respect, right? So Alan, is there a vulnerability to mark down the asset value in Shant, other guys?
I'm a worrywart, Marty, as you know. So we would not mark down an asset unless it became impaired. And with a LTV of actually 38%, we have lots of room to be wrong before there will be an impairment. A. B, we're doing short-term lending. At the end of the first year, if we're happy at that point with the collateral value, we'll renew the loan. What the heck? It's very attractive paper. If we're not happy, we'll call the loan.
So the average duration is a year, and you only will lend on 30% of the value.
Actually, the average duration in the pooled vehicle is about 4 months, 4.5 months, because we'll renew occasionally at a quarter at a time. So the duration is even shorter, which gives people comfort on the yield. And our average LTV is 38%.
38%. Okay, got it. Okay, and can the others also make comments on that?
Sure, I'm happy
Shant?
to go. Yeah.
Yep.
So obviously we have a very different asset class than Alan's, but I'll use some of the same nomenclature. So our LTV is roughly in the 5 to 15% range. Our V here, so to speak, is the valuation that was pegged by the venture equity guys. And we do that just to make it very consistent and easy to parlay. And so imagine, if you were a $2 billion company during the height of the pandemic and all the capital that went in, even if your valuation got axed down to 500 million, 300 million, our loan size is only in the $20 million range. So we have plenty of room for degradation to happen on the valuation side. Furthermore, what we target are mission critical technology companies with very strong revenue bases. So we are much less sensitive to what the market thinks the enterprise value of the business is. So we're not equity holders. We don't need to peg to a certain IPO value, et cetera. We peg to the underlying performance of the business. In terms of duration, our typical loans are 3 to 4 years long, although to a T, what happens is these loans end up prepaying. So we invest in companies that are 15 million of revenue. They grow much faster than we may have anticipated. They grow into a different tier of credit worthiness. And so we get refinanced out. We hold on to our warrants, but we get refinanced out. And in many occasions, companies get sold or M&A or they go IPO, but generally our loans are outstanding for about 2 years.
I have a question for Shant.
Yeah.
It's okay with everybody else. Shant, what's the average cycle time on the equity kickers?
Yeah, so that's a good question. So we have had equity kickers returned and exited in as little as 6 months because the next round ended up becoming an acquisition. But I think in general, the warrants are out there for about 5 to 6 years, something like that. Yeah, thanks, Alan. That's a good question.
We have a question from the audience.
Question for Shant. What do you do in case where your valuation is different from the venture equity investor?
What do you do in the case when the venture equity investors' valuation has changed?
So our valuation is always going to be different than the venture equity guys. So just as quick math, if you're a $15 million high growth, 15 million revenue, high growth software business, the venture equity investors might value you at 10 times revenue, 8 times revenue, depending on the quality of the syndicate and the product, et cetera. We might come in and value you at about 1 to 2 times revenue, just because we build in liquidation value. You know, if there's a software product, if it needs to be sold, who buys that? In whose portfolio would that product exist? And so we value it at, let's say, 1 to 2 times, and then we'll end up lending at less than 1 times. So there are different levels of valuation when we do our underwriting and our advance rates.
There was an audience question as well. How is your performance versus Horizon?
That's publicly traded. Yeah.
Yeah, that's hard to say. I don't really follow Horizon all that closely. There are a few publicly traded venture debt firms. So there's a ton of data out there. I think Horizon is on the slightly smaller side on the deals. They've been around for a while, and that's all I can probably say.
You know, by definition, the niches that you guys play in they're niche-y, they're smaller, but it seems you guys have lots of capacity. Is the issue of what you're doing? I mean, is finding people, or how do they find you? I mean, it seems like, you know, a dozen venture lenders in a massive space is pretty small.
That's right. And what's happened is before we even begin to reach out to our sources of deal flow, which are the venture equity firms, the board members, the CFOs we financed in the past, they find a way to get to us. And so currently we have a very large and healthy pipeline before we've even properly gone out and sought a lot of these sources. It's simply a function of an imbalanced supply demand, which works in our favor.
So do most of the referrals for you and Will, do they come from other VCs? And Alan, you can jump in also. Do they come from people in the business or from the person seeking the loan who found you on the internet, or is it a combination? You guys have multiple channels set up? How does it work?
Yeah, I'll jump in. Ours is omni-channel. We do have a partnership program where we talk to accelerators and incubators and other VCs, and it's pretty easy sell for them. They don't want to necessarily just say no. So they can say, no, not for us, but hey, go check out Chisos Capital. So we get referrals. We also do just some content marketing. So we try and put our information out into the world where entrepreneurs, or increasingly where athletes, are hanging out and looking for financial information. So it's definitely omni-channel.
Yeah, that's an interesting niche you've got there, Will. Alan, how do people find out about you?
In our case, having been around for a while, that helps. But as you know, Marty, I started an insurance exchange years ago, which got to be quite sizable. We own the URL artlending.com. And to my constant amazement, we don't do any keyword buying, none of that. We get about 100 people a day that hit that website and find out about us.
Wow.
Whether it's an individual collector, a dealer, it's pretty amazing.
And Shant, how do people find? I mean, it sounds like it's VC referrals, or?
Yeah, a number of deals come through the venture equity investors that we've done business with in the past. It could be a board member, CFO, CEO. Ironically, there's a healthy cohort that comes from firms that we had actually passed on earlier because they were too young, and they've grown up nicely and they're perfect candidates for venture lending now. So we track a lot of those firms in our databases as well, and so that forms a nice input as well.
Bill, let's get to Bill, because we haven't asked him yet.
Oh, that's okay. You know, I was gonna say for Shant, you're correct. There are very few people in the firm, and I would say most people don't even know about that space that exists. I think if you look back 5 years ago to investment bankers of dealing with the market, not everybody, the space was unknown. You had Hercules, you had Horizon, and that's all you knew about. There wasn't a lot of information.
Right.
So I think this is something that's in our toolbook anyhow, something very useful to have when we can't fund another deal. This is kind of always a fun product.
Bill, how do people find you?
We actually go out and find them, and it typically comes either many times the best deals are from people we know already from various sources, but we also have a bunch of people who actually go out and look for deals, talk to entrepreneurs. I'll talk to 20 people, they'll have 20 conversations a week with people. And then they'll find likely suspects, and we'll go discuss them. And those we think we can fund because we know the investors, or that we think they have a good product and we can do something, we'll take on it. So it's really a lot of work for a lot of the day-to-day grind it out. I don't do that. Let someone else do that. Yeah. Hey, Alan, that's hard work. Yeah.
Indeed.
Let me deal with the entrepreneur, but let the other guy bring it.
Well, it's wonderful that that people get to know about you. These might be niche products, but hopefully allocators will look for something that's uncorrelated and reliable and interesting, right, to add to their portfolios. Thank you so much to the panel.
Thank you.
Yeah, great job. Thanks so much, Julia.
Thank you, Julia.
Thank you so much.
And I just have a couple of observations. I mean, it's just such a fantastic space. Private credit was a space that our group was heavily involved with after 2008. I think the next couple of issues haven't dropped yet on this economic cycle. And I think private credit is going to come in a very good way. And there's probably going to be a lot of, impaired credit where assets are marked down, and you see a lot of secondaries in that space coming out. And I expect the people on this panel